Hello traders, James Stanley with StoneX and Forex.com. We're finally at the December Fed rate decision, and it's not really even a debate at this point as to whether or not the bank's going to cut. Market probabilities are currently showing over 87%. I think that should be closer to 95 or 98%. The Fed, especially since the financial collapse, have been very cautious of disappointing markets. And if we're in a spot where there's an 87% probability via market rates that the Fed will cut, it's not a situation where they really want to let people down. If they did, then there could be a mass influx of volatility. Then that could create a whole other host of problems that they'd have to deal with. So for next week, I think a 25 bip cut is fairly well baked into the cake. The bigger question is 2026 and thereafter. And interestingly, even though the Fed has cut rates 50 bips already this year, 75 bips if they do cut again on Wednesday, and then 100 basis points last year, a total net of 150 so far, 175 with another cut next week. Even with that, there's been a generally bullish response in the dollar to FOMC rate decisions. One of the big reasons for that has been Federal Reserve Chair Jerome Powell. He's been very reticent to commit to additional rate cuts, and that's a factor that may be shifting in the near future. Kevin Hassett, current director of the National Economic Council, is apparently in line for the next Fed chair position. He has a history as an uber dove. And I think that's had impact in rate expectations as we go into next week's rate decision. So I wanted to look at the dollar from a few different vantage points. I wanted to look at it from the perspective of eurodollar, which I think is still the key as to whether or not DXY is going to show any legitimate trends. I want to look at pound dollar, as I still think that's the most amenable venue for USD weakness to continue. And I also want to look at dollar yen, as dollar strength I think could continue to play out very nicely in the setup that's showing in dollar yen right now. Of course, there's a Bank of Japan rate decision to look at the week after the Fed, and I'm going to touch on that in this video as well. So let's get to the chart, start taking a look, and see where we can devise some strategy. So first and foremost, in the USD, it was that 122 level. 100 spot 22 is what came into play last year in September when the Fed started cutting rates. It held the lows, and even though the Fed cut rates another 2 times for a total of 50 bips in Q4 of last year, the dollar rallied massively. It was as we came into this year, as recession fears started to take over, as more rate cuts started to get priced in, that the dollar really, it tanked into April. I mean, there was a clear and decisive short side trend. Since April, though, when we hit that 98.98 level, it has been very grindy, back and forth. 98.98 was support, and then resistance, and still support. Perhaps ironically, as we move into the weekly close, we're looking very near that 98.98 level for the weekly close. There's a little under an hour left as of the recording of this video. So assuming that we close where we are, we're literally rounded up to that 98.98 level right now. It's a big spot in USD. But as I always say, price is price. It's objective. You got to respect what it's done. And if we look at this from the 4-hour chart, it's been a series of lower lows and lower highs, and bears have a shot to show greater control next week. Now, on that, right now, markets are heavily expecting more rate cuts in 2026. And again, like I said, I think that a cut next week is already baked into the cake. We're at 87.2%. I don't think the Fed would want to disappoint markets in these expectations right now. So I think we're going to get that 25 bip cut with a high degree of certainty on Wednesday. To the end of next year, though, markets are looking for another 50 or 75 basis points in cuts. That is where the game is. If we look at the summary of economic projections from the September meeting, this is when the Fed started cutting rates this year, notice that most Fed members were expecting rates to end next year quite a bit higher. 3.5 to 3.75% is represented by these dots. The current expectation for 275 to 325, that shows all the way down here. So for the Fed to meet market expectations at this next rate decision, we're going to need to see some of these dots dropping down into that 275 to 325 area, which I do think is quite possible. But if that happens, the question I have is whether or not USD bears are going to have ammunition to make much more of a mark here. Now, as usual, we got to look at this from the design a composition. DXY is merely a basket of underlying currencies. So if we are going to see the dollar drop, we're going to need to see other currencies taking on strength. And I think one of the reasons the dollar has been stalled at this resistance has been, and goes back to, its largest constituent, the euro. The euro is 57.6% of the DXY quote. And even when we were in full breakdown mode, I was warning of chasing breaks below this 115 handle. 115 is a massive price in the history of the euro. If we go back to 2015, 2017, there's like a 2.5-year range in the pair. 115 is that delineating line of resistance, 105 as support. When we get a fundamental driver, it can eventually leave it behind, but even when a fundamental driver is getting priced in, it will have a tendency to slow and then stall the move. This is COVID. Even in the panic of COVID, that line in the sand sets the high. And then as the Fed is gearing up for rate cuts to address inflation in late 2021, 2022, 115 slows the move. It's the last kiss of lower high resistance before we got that break below parity. More recently, when we had the rally in euro, the sell-off in DXY pricing in earlier in the year, when we had that 98.98 test, that initial one in DXY, it was 115 in euro that stalled the move. We got above, couldn't make much ground above. And since the breakdown has attempted to get started, it's been a series of higher lows ever since. Now, this week was the week where bulls had an opportunity. They had an open door to run with the trend. We had a push up to a fresh higher high, going along with a higher low right off of that 115 handle from a couple of weeks ago. I looked at that in one of these videos. And we can't quite say that is nullified yet. If you go down to the 4-hour chart, very similar to the bearish action in DXY, there's bullish action here. 115.93 to 116 is key support. This is what bulls need to hold to retain a degree of control. If they get below that, or if that price breaks, then it's going to start looking like that breakout has failed. The door reopens for a retest of 115.50, and then ultimately that 115 level. But if we're looking for dollar strength, again, I still think there's a more amenable pasture elsewhere, and that's against the Japanese yen. But let's first entertain the premise of dollar weakness. Now, again, there is a claim to be made for bullish structure now, given that we have this fresh higher high to go along with a higher low. But if you notice, that swing high from mid-November, we have not been able to remain above, right? We tested above that on Wednesday, we dropped back below yesterday, and then so far today, that's held as resistance. That's that same mid-November swing high. So while we've technically set a higher high, we haven't been able to hold it. If we compare this to cable, cable has a much better developed bullish trend. That's the mid-November swing high in pound dollar. We broke above that a couple weeks later. And then this week, I looked at this one in the webinar, where we were right at 131.86, a spot of prior support, turned to resistance, and it came back into support. At the time of the webinar, we were bleeding down right on that level. It ultimately held through 2 consecutive 4-hour bars and led to a pretty vigorous bounce. That bounce has sent us right back up to next resistance. So if I'm looking for the dollar to break down, while that setup in euro is a little bit more tenuous, and even if that euro setup does break out, there's more resistance overhead, I like this setup in cable quite a bit better. For structuring, if we look at this from the daily chart, there's a couple of spots that stand out. This prior swing around 132.87, that's my S1 level. S2 of 132.50, this is a major psychological level in cable. It has had quite a bit of impact in a few different ways, historically speaking. More recently, and perhaps more importantly, this set support and then was resistance for like 3 consecutive days into this most recent week until we had a pullback to that higher low support. If we get a pullback there, that's an S2 level. That's ideally what bulls would hold in a deeper pullback type of scenario. But even if we do see that pullback run for a bit more, 31.86, that spot of support turned resistance, this is now the level that buyers need to hold to retain a degree of control. If they let that go, then that's going to look like failure from bulls to run with the break, to hold a trend. Then that reopens the door for a retest of 131, 131.17. And at that point, depending on the way that zone comes into play, maybe there's a bullish reversal to work off of that. But structure is important for that reason. It's an if-then statement. If this doesn't hold, and then something has shifted, something has changed. And my anticipation in that scenario is that the dollar strength that we're seeing will look a lot more favorable elsewhere in a pair that has been holding up a bit better against a weak USD. And I'm specifically talking about the Japanese yen. Now, there is a bit of drama here. I'm going to call that out right up front. That drama is the fact that the major factor that has been pushing the pair, specifically since April, but in a larger degree since 2021, a Bank of Japan that does not show a willingness to keep up with FOMC, with higher rates from FOMC, thereby leaving for a rate differential between the two economies represented in the pair. That's going to shift. As we're getting a cut or a highly expected cut next week, we're also looking at a highly expected hike from the Bank of Japan a week later. But there's drama behind that. Because the same trade that was encouraged by this move, the carry trade, it brings with it the possibility of collateral damage if it does break down. So, very similar to how we're going into next week's Fed meeting, and the cut is really well telegraphed and really highly expected. At the Bank of Japan, it's all about the innuendo as to whether or not the BOJ lays the groundwork for more hikes next year. Now, as it stands, if the BOJ does hike, we're going to see that rate differential between these two economies narrow a little bit. But it's if the BOJ signals many more hikes on the way, thereby scaring the long side of the pair, and that there will be even more tightening between rates from these two economies, that could compel a pretty nasty scenario. Now, we can see what happens when a one-sided trade snaps back as it did in Q4 of 22. That was a 50% retracement of the trend that took 21 months to build. So from the low in 2021 up to the high in 2022, 50% of that was erased in like 3 months. And it was all really just kind of a reset on the back of a weak US CPI report after the BOJ had intervened to defend 150. And then a year later, we saw a 23.6% retracement of that same move. Again, a weak US CPI report, the prospect of change. But really, this trade, this backdrop, was fuel for the moves that we've seen in risk markets over the past couple of years. Because if you're a hedge fund, and you could go to Japan, and you go to a Japanese bank, and Japanese bank rates are at 0% or close to it, you could borrow funds at a really low rate. And then you could just go and invest it in the US and say like treasuries, where rates are significantly higher. You could try to pocket the spread between the two. As the treasury trade gets more and more bought up, you can look elsewhere. You could take on more risk, like say like tech stocks, for instance. And the AI trade was massive at the time. And so that cheap Japanese capital can essentially drive capital flows and leverage into markets like the AI trade. Now, all that's good and fine, but if you're getting a bank loan in the Japanese yen, you're essentially long yen. And if the BOJ is not hiking rates to stay in pace with the Fed, well, now you risk losing on the currency side of the trade. So what you need to do is you need to hedge that currency risk. You can do that by selling the yen, buying the dollar, thereby leading to more demand in dollar yen. Again, all good and fine until it's not. When you get those crowded trades, it becomes like the crowded movie theater with the small little exit door and you start to smell smoke. Are you really going to wait around? Or are you just going to slam for the exits and then ask questions later? That's what can lead to these fast reversals, these fast pullbacks. You'll notice in dollar yen, it's kind of an up the stairs, down the elevator type of modal here. Now, it's what happened last year that showed the collateral damage that can happen when the carry trade comes off. We saw on the morning of July 11th, the US CPI report came up below expected, but we also had the Bank of Japan intervene. Quickly, this was spiraling lower. And notice, it was, again, Thursday, July 11th, when that move started to spark. And you could look somewhere like the NASDAQ. NASDAQ 100, Thursday, July 11th, right there. Put in a nasty turn for the worse. And that was a continued run that lasted for a while, all the way till the morning of August 5th. Now, the morning of August 5th is also interesting because if we look at VIX, it spiked to its third highest level ever that morning. Again, driven by the unwind of the Japanese yen carry trade. And that was largely because of the leverage that had been funded into these risk markets on the back of that trade. Anyways, the whole reason I'm bringing this up is because if Kazuo Ueda does signal that more rate hikes are on the way, and he scares the long side of the pair, it might not take long for more of that global deleveraging to show up. As a matter of fact, if you look at the way that dollar yen was in the swan dive earlier in the year, I don't think that it's coincidence that it bottomed right around the same time that U.S. equity started to come back to life. And you'll notice, it's that 140 level. That's a major line in the sand right now. So I think the BOJ, the week after the Fed, we're going to see a way to hike rates, 25 bips. And then I think he's going to stay mum on rate policy moving forward. I think he's going to try to be as conservative as humanly possible while hiking rates and hoping that the rest of the situation takes care of itself. Now, in dollar yen, and I think this is the reason I'm probably more convinced of that backdrop, it's objective. Price action is bullish. This is the same zone I was looking at for support as we came into this week. It's 154.45 to 155 flat. If you look at this, that is still a strong bullish trend that's only had a minor pullback in the grand scheme. And then on a shorter term basis, I think there's even a justification for looking at this in a more bullish light. This is a falling wedge formation that I'm pulling off the 4-hour chart. Falling wedge is often approached with aim of bullish reversal. And the fact that it's the support zone that's been helping to hold those lows on the daily makes it a bit more attractive on the long side. But if I'm looking to push USD strength, this is the area I want to do it. And as we go into BOJ a week later, that's something we'll contend with when it's on the radar. But for next week, it's all about the Fed. It's all about these dots. It's all about whether or not the Fed is going to cave to market expectations and get more dovish as markets are looking for another 50 to 75 bips in cuts next year. And until we get inflation data that pushes the bank away from that thesis, I think they're going to go with it because they don't want to rock the boat. They don't want to upset the apple cart unless they absolutely have to. That's at least the Federal Reserve that we've come to know and love in the post-GFC backdrop. But that, my friends, is what I have for this week. Wish everybody great luck in the week ahead. And as always, happy trading, ladies and gentlemen.